Chapter 9, Receivables. In the ordinary course of business, not all customers pay with cash. Most business customers and some consumer customers buy on account. That is, they take possession of goods now and pay later, or they receive services now and pay the bill later. This credit relationship between businesses and their customers creates both accounting challenges and receivables management challenges. In addition, it is normal that a certain portion of our receivables will never actually be collected. Notes receivable arise when we loan money to our customers. Sometimes customers have large accounts receivable balances that they are not able to currently pay. In those circumstances, companies may sometimes convert a current account receivable to a long-term note receivable. Other times, the nature of the product or service performed may require a very large payment. In those circumstances, a company may finance the sale for the customer. There are also other receivables that arise during the course of business. Examples include dividends owed to the company as a result of their marketable securities investments, interest due to the company, or tax refunds due from the government. As stated earlier, anytime we sell on account, a receivable will be created. In our example on August 8, Smart Touch Learning performs $5,000 in services for Brown on account. In addition, Smart Touch Learning sells $10,000 of inventory to Smith on account. Prepare the journal entry for each transaction. The entry to record the services performed for Brown will include a debit to Brown's account receivable account and a credit to service revenue. The entry to record the sale to Smith will include a debit to Smith's accounts receivable account and a credit to sales revenue. Each of the sales is initially recorded in a subsidiary account receivable account. Each customer, in fact, will have their own separate account receivable account. The collection of these individual accounts receivable accounts is referred to as the accounts receivable subsidiary ledger. It is obviously impractical to include each individual account receivable on the balance sheet. Instead, a control account, referred to generally as accounts receivable, is maintained, which will represent the total of all the individual subsidiary accounts. Today, most customers do not pay with cash. Many pay with plastic, credit cards, or debit cards. For all practical purposes, the seller treats these plastic purchases as cash sales. The primary difference is that credit card and debit card companies charge sellers each time they process a credit or debit transaction. This is the primary source of revenue for credit card and debit card issuers. A typical charge can range from 1 all the way up to 5% of a sale. Under the net method, the seller records the total amount of the sale at the time of the sale. The anticipated amount of the fee is deducted, and only the net amount of cash is actually recorded. On August 15, Smart Touch Learning sells merchandise to a customer for $3,000. The customer pays with a credit card. The credit card company assesses a 4% fee. Record the journal entry. The full $3,000 is credited to sales revenue. 4% of the sale, or $120, is charged to credit card expense, and the net amount of cash, $3,000 minus $120, is debited to the cash account. Under the gross method, the full amount of the sale is credited to sales on the sale date, along with debiting the full amount of the transaction as cash. The credit card fee is recorded later when the credit card company actually deducts the amount from the cash they pay to the seller. This will require 2 journal entries on different dates. On August 15, Smart Touch Learning sells merchandise to a customer for $3,000. The customer pays with a credit card. The credit card company assesses a 4% fee. Record the journal entry. On August 15, Smart Touch Learning records a debit to cash for $3,000, the full amount, and a credit to sales revenue for $3,000. On August 31st, the credit card company assesses the 4% fee. The credit card expense is debited for $120 and cash is credited for $120. On June 30th, Phoenix made $12,000 of credit card sales. The processing fee is 2% and Phoenix uses the net method. Record the transaction. On June 30th, Phoenix will credit sales revenue for the full amount of the sale, which was $12,000. Credit card expense will be debited for $240, which is 2% of that $12,000, and then cash will be debited for the net amount of $11,760. On June 30th, Phoenix made $12,000 of credit sales. The processing fee is 2%, and Phoenix now uses the gross method. How would we record that transaction? Well, on the 30th, Phoenix will debit cash for the full amount of $12,000 and credit sales for the full amount of sales revenue for the full amount of $12,000. Just a note on this slide again that the reason you don't see the next portion of that is because on the 30th you will record the full amount, and then this triad doesn't mention anything about when you actually are getting paid from the processing company, and so you'll have to wait until the credit card processor actually deducts the fee before you can do that journal entry. It is an inescapable fact of doing business that a company will not always collect 100% of its accounts receivable. For various reasons, some customers will be either unable or unwilling to pay. When this occurs, we must acknowledge in the accounting system that previously recorded accounts receivable are no longer collectible. The bad receivables must be taken off the books, and a corresponding bad debt expense must be recorded. For companies that are not required to follow GAAP, the direct write-off method is the easiest and most straightforward approach. Essentially, when an account is determined to be uncollectible, it will be removed with a credit to accounts receivable, and a debit will be recorded to bad debt expense. So basically just wait for it to happen and record it. On August 9th, Smart Touch Learning determines that it will not be able to collect $200 owed by Dan King related to a May 5th sale on account. How would you do that under the direct method? Well, as we said, Dan King's subsidiary accounts receivable account and the control account will be credited for $200 to remove the uncollectible account from the books. In addition, a corresponding $200 debit will be posted to the bad debt expense account. And if you look at the date, it shows that that will be posted whenever we find out that this is uncollectible. Even though customer accounts are sometimes written off, the customer may still feel an obligation to pay the amount owed. If at some future date the customer is able to send in the original payment, the company will have an accounting problem. How does the company receive a payment for an account that no longer exists? The solution is a two-entry approach that first reverses the earlier write-off and second records the receipt of the payment against the newly reinstated account receivable. So on September 10th, King pays the $200 that was written off on August 9th. First, reverse the earlier write-off by just switching the debits and credits, so by debiting King's accounts receivable account and crediting bad debt expense. Second, debit cash and credit King's accounts receivable account as if there had never been any bad debt write-off there. In order to be in accordance with generally accepted accounting principles, companies must account for their uncollectible amounts using the allowance method. Essentially, the allowance method is based on the matching principle. In retrospect, accounts that we determined to be bad today were actually bad from the moment of sale, though we did not know it at the time. In order to match the revenues recorded at the time of sale with the expenses related to that sale, some of those expenses would include bad debt expense, we must make some type of estimate of what we think the bad debt expense will be in the same period as the sale to which it is related, even before we know specifically how those accounts will play out. To do this, we rely on past experience and our understanding of the particular account and system of accounts. We know that the older accounts and the older an accounts receivable account is, the less likely it is that we will be able to collect it. Or in other words, most accounts receivables that are eventually collected are collected fairly quickly. At the end of each period, we will make an estimate of the bad debt expense and record a related adjustment in a contra asset account called allowance for bad debts. This carries a credit balance. The allowance for bad debts will be deducted from the accounts receivable account, and the difference will be reported as net accounts receivable. In the future, as actual accounts are determined to be uncollectible, they will be written off against the allowance for bad debts. On December 31st, Smart Touch Learning estimates that $80 of its $4,400 of accounts receivable are uncollectible. Here's how we would prepare the journal entry. Assuming that the allowance for bad debts currently has a zero balance, then the entry will include a debit to bad debts expense for $80 and a credit to allowance for bad debts for $80. On the balance sheets, the two accounts will be shown together in the assets section, with the allowance for bad debts credit balance reported as a reduction of accounts receivable which carries a debit balance. Many companies do not actually report both accounts on the balance sheet. Instead, often all you will see is a single line item called accounts receivable net, which would be the sum of those two accounts. As we go forward into the future, we often discover that a specific account will be uncollectible. At that point, in order to make the accounting records reflect the appropriate state of affairs, the uncollectible account should be written off. This will entail a credit to the appropriate accounts receivable subsidiary account and a debit to the allowance for bad debts account. On January 10, 2016, Smart Touch Learning determines that it will now collect, or that it will not collect, $25 from customer Sean Callahan. This is how we would prepare the journal entry. When we write off an account, we have to remove it from the books. Because Callahan's account receivable had a debit balance of $25, we will credit it for $25. This effectively removes it from the books. We will debit the allowance for bad debts account for $25, eating up $25 of our allowance. Occasionally, a customer will still decide to pay us even after the account has been written off. The solution will require two entries. The first entry will reverse the earlier write-off, and the second entry will receive the cash against the reinstated accounts receivable, similar to what we saw previously. So on March 4th, Smart Touch Learning receives $25 from Callahan. However, there is no account on the books any longer against which to charge the cash receipt. How do we prepare those journal entries? The first entry will reinstate the original account receivable by basically reversing what we did to get rid of it. So debit accounts receivable Callahan and credit allowance for doubtful accounts for that amount. The second entry will debit cash for $25 and credit accounts receivable for $25, just as you would have done if the account was paid on time. We have not yet addressed how we actually determine the amount of the allowance for bad debts account. There are three acceptable methods. First is called percent of sales, second is called percent of receivables, and lastly, aging of receivables. In the percent of sales method, we will base the target balance for allowance for bad debts on a percent of credit sales for the period. For this estimate, cash sales are not relevant. The percentage will be based on experience and on actuarial assessment of historical patterns. Once the percent is known, the estimate for the target balance in allowance for bad debts is a simple computation. In the percent of receivables, we apply an uncollectible estimated percent to the ending accounts receivable balance. And again, we come up with that percent similar to the way we did in the previous example. The most common method is called the aging of receivables method. We first break the accounts receivable into age groups. Each age grouping will have a different expectation of how much will be, or when an account is bad. Once we know the target balance for allowance for bad debts, and we know the existing balance for the allowance for bad debts accounts, we can determine the bad debts expense as the difference between the two previous totals. Examine Exhibit 9-1 showing the aging of the accounts receivable for a group of customers. Total accounts receivable is $6,375. However, that balance can be broken down into 4 balances. Each of those balances represent various transactions of differing ages. We can tell from the table that our target balance for allowance for bad debts is $185. Based on prior transactions, we see that the current balance in allowance for bad debts is $55. Because the target balance is $185, we will need to adjust the current balance in order to increase the balance to $185. So this is how we would prepare that journal entry. The entry will require a debit to bad debts expense for $130 and a credit to allowance for bad debts of $130. This will effectively adjust the allowance for bad debts balance from $55 to $185. Notes receivable are another kind of receivable. Notes receivable are generally characterized by the presence of a promissory note signed by the borrower or maker of the note. The promissory note will contain certain required components. The note receivable is recorded on the date that the promissory note is signed, and interest will have to be accrued periodically as necessary. In order for a note receivable to be enforceable, it must be evidenced by a signed promissory note. The note must have 4 primary components. The principal amount must be stated on the face of the promissory note. The interest period must be identified. The interest rate must also be identified. And the promissory note must be signed by the maker. On September 30th, Smart Touch Learning loaned $1,000 to Lauren Holland for 1 year at 6% annual interest. Remember, all interest rates are always stated as annual rates. Prepare the journal entry for the issuance of the note. So this is how it would look. The entry will require a debit to notes receivable Holland for $1,000 and a credit to cash for $1,000. Remember that interest is recorded only after time has passed. So at the initial outset, we're only recording the principal and the change in cash. At the end of the accounting period, if the note is not yet due, then interest will need to be accrued. The approach is fairly straightforward. Principal times interest rate times the fraction of the year that the note has been outstanding. On December 31st, the $1,000 loan to Lauren Holland is not yet due. However, 3 months have passed since the loan was made, so interest must be accrued. This is how we would prepare that journal entry. The computation is straightforward. $1,000 times 6% times 3/12 or 1/4 of the year that has passed by. This gives us a total of $15. The entry will require a debit to interest receivable for $15 and a credit to interest revenue for $15. If a note receivable is deemed uncollectible or goes into default, it is often first transferred to an account receivable along with any unpaid interest. We will then apply our accounts receivable policies to determine when this new account receivable will be written off. On August 1st, Taylor Company loaned $80,000 to L. King on a 90-day 5% note. This is how we would prepare the journal entry to record just the issuance of this note. The entry will require a debit to notes receivable L. King for $80,000 and a credit to cash for $80,000. Again, remember, since this is just the issuance, there is no accounting needed for interest at this date. On October 30th, King pays the $80,000 note and the 90 days of interest. This is how we would prepare that journal entry. Taylor will receive sufficient cash to pay off the original loan and to pay for any interest that has accrued over the period. That interest is computed by taking the $80,000, multiplying it by 5%, and then multiplying the percentage of 1 year that has passed. So that would be 90 divided by 360, or again 1/4, giving us a total of $1,000. Once we have that total, the entry will include a debit to cash for $81,000. So you have the $80,000, which was the original principal, plus the $1,000 of interest, a credit to notes receivable, L. King, for $80,000, and a credit to interest revenue for $1,000. Using the information included in Exhibit 9-5 for Green Mountain Coffee Roasters, we will look at 3 common ratios used to evaluate business performance. These are the acid test ratio, the accounts receivable turnover ratio, and the days sales in receivables ratio. The acid test ratio is a scaled-down version of the current ratio. Essentially, it will include only the most liquid assets in the numerator. These are cash and cash equivalents, short-term investments, and net current receivables. We will divide by total current liabilities. The result is a ratio that gives us a rough idea of whether the company currently has sufficient liquid assets to cover current liabilities. Using the numbers from Green Mountain Coffee Roasters, we can see that the acid test ratio is 0.74, rounding to the nearest 100th. The accounts receivable turnover ratio is computed by dividing net credit sales for the period by the average net accounts receivable for the period. Typically, average net accounts receivable is computed as beginning net accounts receivable balance plus the ending accounts receivable balance divided by 2. As this number goes up, it is an indication that sales are slowing down. For Green Mountain Coffee Roasters, assume that net credit sales for the period are $2,650,899. The accounts receivable turnover for Green Mountain Coffee Roasters under those assumptions for this period is 10.99, rounding to the nearest 100th. And you can see the calculation for that right here. The days sales in receivables is an indicator of the age of receivables. As this number goes up, it is an indicator that collections on receivables are slowing down. Using the information for Green Mountain Coffee Roasters, compute the days sales in receivables number. The days sales in receivables for Green Mountain Coffee Roasters for the period is, rounding to the nearest whole day, 33. So to do that, we just used the ratio we already calculated for accounts receivable turnover ratio and obviously a 365-day year.